managerial accounting, absorption costing versus variable costing. Now, up until this point, we have been following the traditional view of assigning costs to inventory. And that traditional view is that every cost, ordinary and necessary, to get the asset ready for its intended use should be charged to the product inventory account. Those are the inventoriable costs. And that is the approach taken under absorption or full costing. In this series of videos, we're going to look at some of the problems that absorption or full costing inventory approach can create for internal decision making and in terms of motivation for managers to be engaged in dysfunctional behavior. And we're going to compare the absorption costing approach with a different approach called variable costing. And we've seen the variable costing income statement in other videos. That is the contribution margin income statement. Now, let's first just review the fundamental differences between absorption costing and variable costing. First of all, absorption costing assigns fixed manufacturing overhead along with direct materials, direct labor, and variable overhead to the product. Now, how does that happen? Well, what we have to do is we have to take the total fixed manufacturing overhead and allocate that to individual units of product by calculating a per unit fixed overhead rate. Now, what we do, the way we calculate that, you may recall from our predetermined overhead calculation, is we take the total estimated overhead, total fixed overhead, and we divide it by the number of units produced. If we're doing a predetermined overhead rate, then it's estimated total overhead divided by the estimated total number of units, or whatever our allocation base is. Now, in this series, we're going to assume that the allocation base is always the number of units produced. Now, how does this differ from variable costing? Well, under variable costing, the fixed manufacturing overhead is expensed in total. Expense in total. So under variable costing, we don't worry about calculating a per unit amount for fixed manufacturing overhead. We treat the fixed overhead on the income statement in the same manner as the cost is incurred, in a total amount, regardless of the level of production within the relevant range or within the period. So, two different ways of viewing how we should treat fixed overhead on the income statement. Now, the absorption or full costing method is a long-range focus because it views fixed overhead in terms of its contribution to the long-term existence of the business. For example, buildings are going to last for more than 1 year, machinery, and so forth. So we need to take a long-run focus in dealing with fixed overhead. Now, that's, again, long-term focus. So absorption, because it is a long-term focus, is used, or actually it is required, for external financial statements under GAAP and for taxes. So for external financial statements, for the income statement and the balance sheet that is published for stockholders and other interested parties, we have to use absorption costing, the full costing approach. Now, variable costing, on the other hand, is more of a short-run focus. This period, we're going to incur X number of dollars for depreciation, X number of dollars for rent. This period, so the focus is on this period. And how should we treat that cost in setting prices in this period, in estimating how many units we need to sell in this period, and so forth. So it's a short-run focus. And because it is a short-run focus, we cannot use variable costing for GAAP or for taxes. However, variable costing, and we've already seen it in earlier videos, variable costing is very beneficial for internal decision making, such as short-term pricing, short-term decisions about whether or not to accept a special order and that sort of thing. And also, because it treats fixed overhead according to the way the cost behaves, that the cost is incurred in a total amount rather than so much per unit, the variable costing approach yields a closer amount to cash flows when we're calculating the variable costing net income. Now, it's not going to be exactly cash flows because of things like depreciation that are non-cash expenses, but it's going to be closer to our cash flow figure on the income statement than absorption costing net income is. Now, in the next video, we're going to be taking a look at some sample data, and we're going to illustrate first some of the issues with absorption costing, and then how we prepare a variable costing income statement and reconcile the differences between the two.